Hi everyone. Happy Thursday. Welcome.
Hi guys. Okay.
Hi Dean. How's the office?
It is lovely. It's lovely. I have a drink in hand. How about yourself?
Same. I have a gin and tonic, considering it's almost the weekend. So pretty happy about that. I might just give everyone a couple of minutes, but before we jump into it, a couple of housekeeping things. Firstly, welcome. It's great to not see you, but have you guys here. We haven't done an index 101 session in a little while, so pretty keen to get back into some of this topic. And it was really cool to see all of the questions come through from people that registered in the last couple of days. So really keen to get stuck into some of that. What we're going to do tonight is run through basically all the kind of key things you need to know around index investing, why it's good, what are some of the challenges around other types of investing, things you need to think about and the benefits. And then we will deep dive into some of the nitty-gritty questions that we'll send through, and also a little bit more about Kernel, but that will be at the end part of the presentation. So all the great educational content will be straight up front. So if you haven't met Dean and I before, I'm Kat. I run strategy and marketing at Kernel. Dean, who is with me, is our founder and CEO. And he's one of, the index investment gurus in our team. We love running these types of presentations and meeting with investors. So he's going to kick us off with basically what is index investing.
Thanks, Kat. Yeah, and so like Kat said, we did actually have a significant amount of questions come in, and we're trying to cover a lot of them. Tonight, we're definitely trying to keep that focused on what is index investing. But by the looks of all the questions coming in, there are clearly a number of other topics that we can be talking about. If you are watching, do say hi and chat so we know that you're there and it's all good. But for now, probably the very first thing to start with, obviously, and it may not be that clear to everybody, is we're going to talk about index investing, we better actually explain what an index is. And it may not be that obvious to everybody. The line that you see on that screen there, I have left that a little bit out of date, but that is actually the performance of the NZX 20 index, I think back since its inception, which was 2007. So you'll often see lines like this. You'll see them for individual stocks, you'll see it for an index, but that is the NZX 20 index performance. Yes, there's been a dip since then. The other thing that you'll often see is that's called the ticker across the bottom there, and you'll see that for individual stocks. And basically, you'll see an index number. So beside that S&P NZX 20 index in the middle, you see that 7,096, and that's just a value. And ultimately, it's a random value, and I'll touch on that later. The key thing that you as an investor are interested in more often than not is the little figure beside it. And in this case, it's showing a green, and that basically means that that index is up 0.42%, so nearly 0.5% for the day. So an index, indices, as they're also known as, they've been around since the late 1800s. And basically, they were originally designed by a couple of journalists, Charles Dow and Edward Jones. And they created an index basically to measure the collective performance of the market. And it was a way to summarize what had happened for the day without having to report on every individual company. And so an index is made up, if you think about an equity index or a stock market index, it's just made up of the companies that are in that relevant index. So you'll be familiar with things like the S&P 500. And all that index is doing is measuring the collective performance of all the companies that make up that given index. Now, originally, that was done on an end-of-day basis. So the figures that you'll see in the newspaper or on the news, that's what happened for the day. But now, thanks to technology and data, that moves in real time, so you can see it down to the second. And so they're a great tool that's been around for a long period of time. Historically, they were used for just measuring the market, measuring the performance of active managers, but now you can actually invest basically in the performance of the index and the companies that make up that index directly through index funds. And that's where we are today. So, Kat, do you want me to talk a little bit? Probably the other thing that people often get confused, or we should clarify, I think, and one of the questions was, what is the difference between an index fund and an ETF? So that's a really common question that we get, and it's an important distinction to make. So an ETF, or exchange traded fund, simply means that the units that make up that fund, the units that you would buy as an investor, can be bought and sold on a stock exchange in the same mechanism that you would basically buy an individual company's share. So you can trade the units in that fund throughout the day with other investors, and the price for those units is set instantaneously in the market. An ETF, though, the strategy that the fund that you invest in can be anything. It could be an actively managed fund, or it could be an index tracking fund. So when you see the term ETF, don't just think that it means it's an index fund. You do want to make sure that if you're looking for an index fund, that the ETF you're investing in is an index fund, or it could be an actively managed fund. Whereas an index fund, like we have a Kernel, when it's an unlisted fund, the units in the fund aren't listed on the stock exchange, what you're doing there is you're buying and selling units in the fund directly from the fund manager. Otherwise, with an ETF, you're buying and selling existing units on market between other random investors through a broker. So it's a bit more direct, and there can be some nuances that we're happy to talk to you later on around differences with tax and different costs, but probably a good little clarity there between what is an index fund and what is an ETF.
Yeah, cool. And I suppose, if you're thinking about investing and the different styles of investing, the alternate to index investing is naturally active management, or sometimes stock picking. But if we're talking about fund managers, it's what's called an active manager. Typically, they're hopefully a slightly more diverse bunch. But active management is something that is getting more challenging than it has been in the past. And we're going to run through, I suppose, what is active management and why it's getting harder, and therefore then start to talk about why index investing can be a really good strategy. So Dean, what is active management?
Yeah, exactly. So just to be clear on those two distinctions, if we think about a good example, the NZX 20 index, it's just an index made up of the 20 largest companies listed in New Zealand. As an index manager, we make no decisions about the individual companies we're investing in, that the fund invests in. We're just buying the companies that are in the index and the weighting that they are in the index. The flip side, as Kat said, at the other end of the spectrum is an actively managed fund. And an actively managed fund has typically higher fees, and it's made up of professional researchers who are trying to pick stocks that they think will outperform the market. They may own 5 stocks, 10 stocks, however many, but the aim is to try and beat their relevant index or benchmark that they compare themselves to. So one is all about trying to do stock picking and research, and the other is just about owning a part of the market. So two different strategies there, and that's pretty much how the fund management world is split. And as Kat sort of alluded to, the active management approach to investing is becoming harder and harder and harder. And there are a number of reasons for that. And over time, we've got more and more data to understand some of the drivers of that. One of the biggest changes that has occurred since index investing, in terms of being able to buy an index fund, started, and now the first index funds were really back in the sort of 70s. The big change has been the professionalization of the investment world. So if you think back to the 60s, and we'll focus on the US here, but in the US in the 60s, the majority of the US stock market was owned by direct mum and dad investors. 90% of all the trading was done by an individual, a mum and dad. They may own some shares in the company they worked for. There was actually very few hedge funds in the world, maybe only 1 or 2. There was really no professional investors. And the trading volumes in the market and everything like that was very limited. So back then, in the 60s, 70s, 80s, it was a lot easier to be an active fund manager and to beat an index fund. And that's because you could have a very easy edge over your competitors in the market just by going out and reading the financial reports of a company or doing a bit of research, because at the other end, on the other side of your investment decision, you were often taking advantage of a mum and dad investor who wasn't putting as much energy or research in. Today, as the financial markets have grown, they've become increasingly professionalized. So some of the figures there you can see, I don't know if anybody's heard of a CFA, but a CFA is basically a 3-year course to become basically a financial analyst professional. And there are 154,000 of those in the world. It's incredibly hard to get. The pass rates are sort of 50%, and there's another 150,000 taking them right now. You can see the size of the hedge fund universe at the moment. And now, Whereas in the 60s, sort of 9% of the share trading was done by sort of institutions and professionals. It's more than 95%. So most of the trading activity is going on is between professionals, and that is the key, because the ability to outperform is really driven by how much skill you have compared to the rest of the market, not how much your overall skill is. I have no doubt that the professional active fund managers today are far more intelligent than those that were in the 60s. They've got far more information, faster data, faster trading systems, real-time information, but so do all their competitors, and they're trading against people with like-minded, with equal PhD degrees, with the same sort of systems. And so that's the key of why it's become so much harder today.
Well, this is a fun one. So a little bit of interaction for you guys. Question for the audience, really. If you're thinking about the past 15 years, and this is the same across every equity market in the world, the data generally ends up being the same. If you were to make a guess, what percentage of stocks do you think outperformed the overall market in that sort of time frame? So would you think that 70% of stocks would outperform, 50, 40? Any guesses? We'd love to hear them.
Yeah, so feel free to submit a chat. We are listening to the comments. Like most people, you would jump to thinking, right, half are going to outperform, half are going to underperform. And that's typically what we see. Like when we're speaking to somebody, and if you ask any professional, it's the gut instinct of thinking, you know, some are above, some are below. What was really surprising when we saw this was actually how different that figure really is. And so it takes a little bit of explaining, but it's a really powerful chart just to get a sense of how difficult it is for the active fund managers to pick stocks. It's not a coin flip. It's not as easy as a 50-50 guess. So what we put on this chart here, this is the performance of all the companies that have been listed on the New Zealand Stock Exchange from 2003 to the end of 2019. And so in that data are companies that have gone bust, in that are companies that maybe IPO'd in 2010. But their performance from either their IPO or their launch through to the latest date is captured. And all it is really is just some bars showing the individual company's performance. So if you look at the bar on, I'm hoping I've got this right, but my left at least, onto the left of the screen, you can see that's returns, companies that have returns negative 100%, i.e. they've gone bust, or between negative 50%. So about 17% of all companies since 2003 have gone bust or had a really poor performance. And that's all it is. All of those bars are just reflecting that. As you can see there are two lines that we've drawn on. The first is the median. So the median line basically says that half of all the companies are to the left of that. So that basically shows that half of the companies since 2003 have either gone bust or given a performance of less than 62%. The average is basically the market return. It's the average of all of those companies. And the average is a lot higher than 62%. The average is nearly 250%. So if you'd owned the market, you would have had a far higher return than if you'd just had a 50-50 guess and you could have ended up with something that was below 62%. Why is the average higher than the median? It's because of that little bar that represents 5% all the way out on the right. And that is what the Americans call the 10-bagger. And that is a company that's given a 10x return, 1,000% return plus. Everybody, of course, we would love to own that, right? So you just, if you could pay somebody and they would give you just that, or if you had great insight in advance, why would you not want to just own those companies, right? You're going to have an exceptional return, far higher than the average. But the trouble with it, obviously, from an active manager's point of view, is it's really hard to do in advance. And so that's why the average is higher, because those few companies pull up the average compared to the median. And so as an investor, you can look at this and go, great, I'm going to really try and aim for those 10-bagger stocks. But you have really high odds. In fact, 75% of stocks perform below the average. That's the key statistic there. 75% perform below the average. So you have 75% chance that you're going to get below average return. Yeah, you may get that 10-bagger, So your key to trying to have a successful investment experience is to basically own the market. That way you're going to ensure that you have some exposure to those large companies, those companies that deliver really large returns, those 10 mega stocks. So you just want to own that diversified exposure. That means you don't miss out on those, because if you missed out on them, you're going to be more like the median return, which is a lot worse than just the market generally. So that is one of the other challenges, and that's just really a structural thing. It's nothing more than the odds of the market, and just you've got to be aware of that when you're going into it and understanding how you should go about investing.
And I think, Dean, it's worth mentioning that this is a feature of equity markets, that returns are not normally distributed. So this is not something that's specific to the New Zealand stock market. This same chart is replicated across every major equity market in the world. It's just the way that the returns are skewed. So it's not a uniqueness to New Zealand.
Yeah, that's exactly it. It's the same in Australia, the US, and it's just part of the fact that some companies do go bust, some have just your average performance, and there are those handful that do exceptional.
Yeah, so I think, we've talked about the fact that we know active management is getting harder. There are things like professionalization and, of course, the skewness of returns that play into this. But how well do some active managers do? Do they, for the most part, all underperform, or do some do really well? What I want to introduce to you now is a report called SPIVA. So this is a report that's done twice a year by S&P Dow Jones Indices. They actually analyze over 1 million indices every single day. So they have a huge amount of data, and they pretty much track every active manager that they can to compare how they're going across different countries and markets against the market average or the index. So what this chart is showing you is the SPIVA report is S&P indices versus active. And this is as at the middle of last year. So we do need a slightly more updated one, but over the time, the numbers generally stay the same. Now, what you're looking at here is the closer that the number is to 100, the worse percentage of active managers have done versus their benchmark. So if we're looking at Australia as an example, over the 10 years to 2019, 82% of active managers underperformed the benchmark that they had chosen to benchmark their performance against. That's pretty significant. As you can see, there's some pretty damning numbers in Chile, 98%. There are times where this number fluctuates, but generally speaking, it is much greater than 50%, closer to sort of the 75, 80%, wouldn't you say, Dean?
Yeah, and you got the data back nearly, I think, 20 years in the US and Australia, and you get like sort of 90, 95% numbers. So it's just so consistent across markets. There are some outliers like India, and that's just the fact that there is probably a little bit more insider information that goes on with trading stocks in India than most developed markets. But pretty much every other market that you'll look at, generally you'll see really large percentage of active funds underperform. And that's due to things like professionalization that we talked about, just the nature of equity markets. It's not just a 50-50 guess and you're going to probably do okay. So a number of elements come to play, and that's the key here. Is it's about when you're starting out investing, right? And if you're thinking about how you want to invest, you're going about it with a view to a 5 or 10 or 20-year window, right? And so you're playing pretty poor odds in terms of trying to pick an active fund manager in advance if you think that they'll outperform the benchmark over that longer period of time. Yeah,
and I suppose that's a good question I want to ask you, Dean, is, these stats would tell us that, sure, there are some active managers that do well and do outperform their benchmarks. So why would we not just invest with those people?
Yeah, so this is averages as well. And so what gets lost in this is, and it's a really common thing across all sorts of, as both professionals and mum and dad investors, and all of us like to think about it. It's the way we kind of report on things is, people will often make a decision based on the past performance of a fund manager or a company, and they'll look at it and go, that was the best performing fund last year. There's been a lot of research to go out there and have a look and see how well do active fund managers continue to outperform. And as we look over time, and if we look at every sort of market, the odds of a manager that may have been the best performing manager for the last 5 years continuing to be the best performing manager is exceptionally low. And we look in Australia, I think from memory, some of those figures in Australia, we're less than sort of 2% in categories in terms of 2% of the funds that we're outperforming continuing to outperform. So again, you can't just find a manager that has done really well and think that that is going to be the one that continues to outperform. So that's the other challenge that comes into it. And that's a huge challenge for an investor when they're trying to do research around what should they invest in and how should they construct their portfolio. And the other stat that we probably haven't checked a slide up for, but I found fascinating, it's really common within active funds to have them close. And so in Australia, over a 10-year period, about 50% of actively managed funds will be closed, wound up, or merged into another fund. And that's often driven by poor performance, or they merge with somebody else. It's a really common thing with an actively managed fund. So that becomes another issue for you as an investor just to have consideration for, and that something that you invest in and the strategy that you've invested in and the manager you've chosen may actually change down the line.
Yeah, I think from memory, some of the data from S&P says that, as an active manager, you're more likely to actually close or go out of business than you are to maintain your persistent performance or outperformance over a period of 5+ years. So, what we're trying to highlight with this slide here is that often in active management, you will see managers advertising really great short-term performance, whether it's a year or, a couple of months or a really strong quarter, but you don't know that they're going to continue that, and it is a real challenge for them. So that is also one of the things that has led to the shift, particularly in the US and Australia, from active management into index. So next time, go ahead.
And that really started to happen post the GFC, actually. So if you look at the US, a big shift from actively managed funds went into index funds after the GFC, when a lot of investors really questioned how well their actively managed funds had performed during that period and looked at the amount of fees they were paying their investors, their fund managers, and realizing actually for a long period now, the data shows they could have been far better off if they had just chosen an index strategy. And that probably leads to your next couple of topics as well, where we talk about
nice
safety.
Big number. Yeah, so I mean, this is $450 billion. Before we explain what this number is, would love to see if there's any guesses on what this is. So Dean's given people a bit of a clue in that, particularly since the GFC, there's been quite a significant shift in the US and Australia. New Zealand is catching up. We have lagged behind a little bit in that sense, but quite a big shift from active funds to index. In the US now, there's around 25 to 30% of the market is invested in index related vehicles, whether they're an index fund or an ETF. In Australia, it's about 20%. When we did the numbers on this in New Zealand a couple of years ago, it was sitting at about 2%. So we are getting there. But $450 billion, Dean, what is that?
And I've just realized, by the way, everybody that has been commenting, that I had it on the private chat column rather than the comments, and I see everybody's guesses coming in. So now that I'm all up to speed, $450 billion is actually the amount that investors have saved in fees alone from being or moving from actively managed funds into index funds over the past 23 years in the US alone. That's not in every other market. That is in the US alone, just in fees. The shift from actively managed funds into index funds has saved $450 billion. So that is money that used to go into the actively managed funds, the managers' pockets. It now remains with the investors, and that's a significant figure and a significant saving. And part of why actually we probably have a little bit of a debate around or critiquing from active managers, because ultimately index investing has really cut into the revenue that these active managers used to earn.
Yeah, so I think now we wanted to sort of transition to a question that we do get asked a fair amount, and it's to do with, I suppose, how safe is my portfolio or my investing, particularly when starting out. And there are sort of two facets to that, because often people want to make sure that the types of investments that they're investing in are relatively safe, but also how do you assess whether a fund manager or the person that you're trusting your money to is also secure. So we're going to tackle those two options or those two areas a little bit separately. So the first one, Dean, diversification. Talk us through that.
Yeah, so there's the safety in that when you invest, particularly we'll say in equity index funds, so you invest in the share market, that doesn't have the same, I guess, safety, or as people refer to it, as say investing in a term deposit or putting your money in a bank account, where the value of the investment that you put in, yes, when you invest it into shares or in the equity market, it's going to go up and down. So there's that element, but you can manage that, and over the long term we know that by being invested in the share market, it goes up. The performance of the share market over the long term is better than property, putting your money in the bank, most other asset classes. The key then is making sure that you spread it around and you have some diversification so that you manage that and you manage that risk. And as Kat's sort of pointing to there are a number of layers to diversification. You don't need to overly diversify, so that doesn't mean you need to go out and buy a dozen funds. The traditional thinking and teaching around diversification was you need to have sort of 10 or 20 individual stocks. But you can do that now with an index fund. So with one index fund like the NZ20, you're actually getting exposure or investment across 20 different companies. So that spreads your risk. The next layer of diversification you want to think about is different markets. So there's making sure that you're diversified and not just invested in one company, but then also making sure you're diversified across different sectors. So you want some exposure to IT, you want some exposure to healthcare and property, and also markets and countries. So you want some exposure to different global equity markets and asset classes. So as we all know, just don't put all your eggs in one basket. We'll do another session probably on how to construct a portfolio, how to think about investing. One thing we do kind of caution people on is they sometimes confuse diversification with thinking they need to go and own 30 different index funds. An index fund is highly diversified normally. They're often diversified across sectors and countries. And so you can actually invest with just 2, 3, 4 different index funds, and actually you've got a really well diversified portfolio that adding more companies and more funds isn't actually doing anything in terms of adjusting the sort of risk that you have. So that's the key thing to think about.
Yeah, and I think, one thing to think of there is it's really easy to overcomplicate it. And we've just had a question come in asking that, previously diversification meant investing in different companies. And that certainly was the case when we didn't have as many ETF or index investment vehicles, available to the investor. But now, part of the reason why index funds came into existence was to provide people with really low cost diversification, because to go and replicate a global 100 fund yourself is not only very time consuming, but it's also really costly from, brokerage, transaction fees, all those sorts of things. So that's one of the main benefits of an index fund as well. The other thing on safety of an investment, of course, is the actual fund manager themselves. And we do get asked this a reasonable amount because Kernel is a relatively new index fund manager. We've been around for just over a year. So we just wanted to touch on this because it is something that is consistent across all licensed fund managers in New Zealand. So Dean, what's our regulations? You went through a long process with the FMA getting our license. So how did that kind of work?
So there was regulation has continued to improve over time in New Zealand, particularly since 2016, where there was a really significant regulatory change in the market that applies to every fund manager in New Zealand. So this little simple graph was really just to try and show you how things are separated and highlight that for every sort of retail strategy or every sort of retail fund that's available in New Zealand, including your KiwiSaver, that you should take relative comfort that if they are FMA licensed, fully well-structured fund manager, then it's the same across every firm. And the key, though, just to touch back, though, it doesn't mean that your investment won't go down. It depends on what you're investing in. But from a safety of what the money that you put in terms of bad behaviour, for example, then that you should take comfort from this. And so what we want to highlight here is that all fund managers in New Zealand are licensed by the Financial Markets Authority. So for us as Kernel, we went through that process where they basically look at every single part of the business and determine if you are credible and well-structured and financially resourced and have the team to be able to maintain and hold a managed investment scheme license. It's called an MIS, and that enables us to run the index funds that we do. So as an investor, if you came to Kernel or with your KiwiSaver, you put your money into a fund. And when your money goes into that fund, it is segregated from everything else. Your money will go in, say, the top 20 fund. That will buy assets. Those assets are held, and the money that's in that fund is held by a custodian, and that is a separate entity that basically is in charge of all the assets in that fund. Now, no fund can be used, the assets in that fund can't be used for anything that Kernel has to pay or for any other fund has to pay. Then there is the supervisor, and the supervisor is also licensed by the Financial Markets Authority, and they're an independent person. They used to be called the trustee, and they are an entity that is basically the eyes and ears for both the FMA and for you as an investor. And they monitor all the activity as us as the fund manager every single month to make sure that everything is going as per normal. When we tell our investors that they're investing in the NZ20 fund, that it continues to be an NZ20 fund and that things haven't changed. So that's their role, and they report back to the FMA every single month on the activities of the manager. So those segregations of the assets are held separately. And so just to be really clear on that, as Kernel, we can't touch any of the assets that are in there. Basically, all we can do is give instructions. So when your money goes into the fund and invests into the companies, all we're doing is basically giving an instruction to say, right, we need to buy these companies. That is managed and held by the custodian or the supervisor looking over top of everything, and everybody reporting back into the FMA. So hopefully that gives some clarity to the structure. It applies across all fund managers. But I think what we've got now in the New Zealand market is a really well-regulated structure that, particularly since the GFC and since the new regulations of 2016, investors should have a lot of comfort that we've got, a really solid market, that there's been a lot of learnings from the past decade over.
Yeah, that's right. And I think, we've kind of touched on so far, well, what index investing is, what is the difference with active management and active investing, how challenging stock picking can be. We've talked about cost and the fact that active management is typically very high cost. And we've also briefly touched on, I think, how timing the market and, picking stocks at the right time can also be a little bit of a challenge. So what we wanted to run through now is, with all the growth in index investing, how far has the industry come? What are your other options? What are the other things you should think about? The things around different themes, sectors, your goals, other considerations. If you've decided that index investing is the way that you would like to run your portfolio, then what do you start to think about?
Yeah. Did we have, as Kat sort of alluded to, now, thanks with the growth of index investing over the past sort of 20, 30 years, there is now a huge range of choice. As Kat mentioned earlier, there's over 1 million indices calculated by S&P, Dow Jones every single day, and that's just one index provider. There's not that many index funds, but there are a significant amount of them out there. And obviously, as investment options have grown, that actually means you've got a lot more choice, so that as an investor, you can customize your investment strategy to suit your certain goals. And so we actually had a lot of questions talking about, and really recurring questions that we get from investors is some that want to think about short-term investing, some long-term, some that are investing for income. So if you're investing for income, because say you were used to be relying on term deposits and now interest rates are so low, what do you do? And so there are options now to look at things like, in our case, we launched a Dividend Aristocrats fund. Funds out there that are specifically targeting higher dividend paying companies so that you as an investor can get an income source. So really, I think from an investor's perspective, you really just need to go out there and think about what is your objective, what's your time frame, and start searching, because there will be funds and products out there that can really suit your own individual goals.
Can I just ask you a question on that, Dean? Because I think, one thing we do get asked, it's pretty impressive that S&P crunch 1 million indices a day. Why aren't there 1 million index funds? What makes an index viable for an investment, and how do we as a fund manager or S&P as an index provider say that, yes, we can invest in the NZ20 or we can invest in the small and mid cap fund? That's probably a better example because that is new.
Yeah, cool. Okay, so there's a couple of things in there. I can see a couple of comments that probably ties into as well. So with the million indices that are calculated, they will cover everything from emerging tech stocks in Vietnam to large cap US equities to total world, right? So it's really, they're out there as benchmarks and monitoring tools. For an investment, now S&P will only allow an index fund manager like us to track an index or invest to match an index if they're comfortable for a range of criteria, if they are satisfied that the index itself provides investors with an investment into a part of the market that meets certain criteria. And one of those things is the liquidity, i.e. the companies that the index tracks have to be traded regularly. They can't be small or too illiquid that if a fund was tracking it and had to buy those stocks because they've got investors coming into their fund, that it would cause issues to the market. So there's a lot of research that goes into making sure that the index is viable for us to run a fund on. We did a lot of work with S&P when we launched. We looked at the market, and for us, when we were looking at the New Zealand market particularly, we were looking at, well, what's the best strategy for our investors? And what do we think is the best strategy for the New Zealand market? We did work with S&P on this, and we found that actually, you'll see some blogs on this, we think that the NZX 20 index is the best index for a core holding. And so that's basically the 20 largest companies. We then wanted something that complements that and to give investors choice, because maybe they've got a different strategy or they want to invest in different parts of the New Zealand market and different companies. We actually had a new index built with S&P. And so the process for that is we worked with them and said, this is sort of the objectives we wanted to achieve. And it is a smaller mid-cap index that invests alongside, basically in companies below the NZX 20. And that index, unlike the 20, can have a varying number of companies. So companies may be added or dropped out of that depending on how well they're performing and how large they are. And so one of the key criteria that we came across with S&P was this whole liquidity thing. Companies can't be below 100 million because as a fund manager, as we had more investors coming into that fund, we didn't want to cause any issues with the market. So those are some of the nuances behind the process to create an index fund. Was there anything else on that, Kat, you wanted to talk about?
Well, I do think, I know we have a question here of, what happens when a company drops out of the index. And I just wanted to, I suppose I can explain when that happens first. So one thing that we haven't touched on is that all indices have their own set of rules. And as part of those rules, they have what's called a rebalancing. Typically, a rebalancing can happen. For most indices, it's quarterly. Some is semi-annually, biannually. And the purpose of that is to basically rebalance the companies or the underlying holdings in that index at that point in time to make sure that they're matching the weightings and basically are in line with the rule set. So when we talk about a company or a holding being added or dropped from a fund or an index, that typically only happens during the rebalance. So a good example is the New Zealand Top 20 had a rebalance in June, as did all of the funds. And during that rebalance, Air New Zealand was actually dropped, which was the first change for quite some time, and a new company was added in. So do you just want to kind of talk us through how is it that the new company is added in? Because it's not quite as simple as just taking company 21 and replacing company 20.
Yeah, so the NZ20 is a really good simple example, right? Because it's basically the 20 largest companies. And so when it comes to the index rebalance, if during the last quarter, that company that was sitting previously, it was maybe number position 20 within the index and within the fund, had fallen in value or hadn't performed as well, and a company outside had performed well, and its value, the total value of the company is now above the company that was in position 20 of the index, that could swap out. Now, it's not just based on the individual day when the index rebalances. That's the key thing there, is it does look at it over a period of time, and there are a few criteria. So it's not just a decision isn't just made on that specific day. But basically, generally speaking, that is what would happen. If a company had fallen in value, in this case in New Zealand, it had fallen in value, and Somerset had been performing well, and it went into the index. So what we do as the fund manager is we have to sell down the Air New Zealand shares out of that fund, and we buy Somerset. And what actually happened is Air New Zealand went into our smaller mid-cap fund. So now we have, if you as an investor wanted to own basically the entire New Zealand market, you could own the NZ20 and then the smaller mid-cap, which is everything else outside. But that's what happens with a rebalance. As Kat mentioned, most general indices like the S&P 500, NZ20, they typically have quarterly rebalances. There can be different frequencies and different criteria. I will just highlight one, for example, was our Dividend Aristocrats. That's a really unique index. And so to be a Dividend Aristocrat, to be included in the index, you had to have maintained or increased your dividends for at least 10 years. That index actually only rebalances once a year in January. So at the rebalance, new companies may be added. But if you cut or suspend your dividend at any time, you're dropped from the index that month. So the fund would sell it. Basically, it's a really harsh index. But what that does is it means that the dividend yield of the fund continues to remain high, i.e. you're not holding companies in that fund who are no longer paying dividends. And if you're cut, you won't be eligible for another 10 years. So it's a bit of a unique index, but there are different strategies, and so Kat refers to, there's different rules. And what I do encourage you to do is S&P have a really good webpage. So if you just search the index for any fund that you're interested in, an S&P index, you can download like a 3-page little fact sheet. And rather than have to go read all the rules of each index, in that 3-page little PDF, you will see like 2, 3, 4 bullet points that tell you pretty quickly exactly what the index does, how does it rebalance, what sort of companies are in it. So it's a really good way to just go and find out that extra bit of information that you may be after.
Yeah, it is definitely a very good site. There's a lot of data there, so it can get a bit overwhelming. But I think it is an important point because we do sometimes get questions around people wanting to understand how the fund works. And, you know, the key with index funds is we work how the rule set is set out. So, you know, S&P or the index fund provider the indices provider rather, has a very strict rule book, and we follow that. So it's really easy to get all the information that you need on that fund.
Yeah.
So I think, Dean, we have had a question come through tonight and also a lot recently. Obviously, term deposits, interest rates are low. It is a bit of a challenge for fixed interest investors. I suppose, 2-pronged question for you. When should you be considering having fixed interest or bonds in your portfolio? Is it an age and stage thing, or is it, something else? And if the answer is yes, you need to have those, do bond index funds exist? Why not? I know we don't have one as Kernel, so we can probably touch on that. But yeah, want to hear your thoughts on that.
So I'm going to counter your question actually and answer another question first. Okay. The index investing thing, there is a blog that we published, and we're probably going to touch it later anyway. Kat was probably going to ask me, but I thought I'd touch on it now. When looking at index funds, there are a number of things you should look at, and it's not just fees. Like, obviously you want to find an index fund strategy, like the type of thing, like, do you want a dividend fund, or do you want growth or equities, or do you want tech? First of all, you want to find a strategy that fits with your objectives. Fees are important. The other one is a thing called tracking difference, and that's basically, as a fund manager, tonight we've talked about how an index performs. Our job as a fund manager is actually to give you as an investor that performance, to match that. We have to do that by investing in the companies that make up the index. But there are a lot of things that come into play there. We have costs to trade, all these different things that mean that it's different to what the index may be doing at any point in time. And there's corporate actions and dividends being paid out. And so when you look at an index that you like, then you want to find an index manager that's delivering that well, and it's called the tracking difference. And we publish that, so it's really public, and you go and find out. You're basically looking at the performance of the fund versus the performance of the index after the fund manager fees. And there are things that we can control that should mean that we do just as good, or hopefully better than the index as well, in terms of aligning with some operational efficiencies. But you do want to go and check that out. And so there's a blog, and happy to refer you to it. I think we called it the seven tips for picking the best index fund. Have a through that. It will tell you the key things you want to keep an eye on after tonight when you're going and looking at different index options. Back to your point of
bonds, fixed interest.
Avoid this topic. Fixed income is incredibly hard right now. When we speak to financial advisors that we deal with, it's a part of somebody's portfolio that used to be really easy. So for a long period of time, if you went and saw an advisor and you were close to retirement, you may have got what was called a 60-40 portfolio. So 60% of the investments was in things like shares and equities and 40% into bonds. That is really challenging right now, because historically you would have had a relatively high yield on the bonds, or a coupon income, and bonds as an asset have generally risen in value, and that's because interest rates have been falling. So as interest rates fall, if you owned a bond fund that had a higher yield on it, that becomes more valuable. Now, with interest rates so low and with term deposits so low, if you are thinking about having bonds in your portfolio, it's actually a lot riskier than probably people appreciate. You are only going to lock in a relatively low yield. So maybe you're getting a 1.5% yield, and then you've got to take fees out of that. There is also the risk that if interest rates start rising again in the medium term, that the value of your bonds or bond fund will actually decrease. So people are having to start to look at alternatives. And what we're seeing is increasingly investors include things like infrastructure, what we call real assets, so physical assets that have some protection against inflation. So if you think about infrastructure projects, they often have revenue that's tied to inflation. So people are looking at infrastructure funds, they're looking at things like dividend funds, and equally some of them are just saying, I'm just going to leave some in term deposits but put more into equities. So there are a number of ways you can go around it. It really it does depend on how comfortable you are with taking on some more volatility or movement in terms of it's going to go up and down if you're in shares typically than what it would if it were in bonds, and definitely if it was in term deposit. In terms of age, in the current environment, some people may be out there and thinking at 30, 40, 50, they need to have bonds in their portfolio. I'm not 100% convinced on that. I think if you're investing for the long term and you don't have a fixed horizon of when you need that money, with the way the interest rates are, that's potentially a reasonable drag on your portfolio, and it does come down to how comfortable you are riding the ups and downs. But if you've got a long time horizon, then maybe you don't need to look at that, and you can look at things like commercial property funds and infrastructure and those sort of funds that we've developed to make sure that you have some slightly less volatile stocks, but you get sort of more of the stock market performance.
Yeah. And I think, you touched on a good point in terms of the goal that you're investing towards. We have been doing a survey this last couple of weeks of our current customers, investors, and a lot of people are saying that they are just investing for the future. They don't really have a specific goal in mind. It's just something, whether it's financial freedom or just generally for their future. And, if you are in those age brackets of 30, 40, 50, and that is your goal, chances are you've got a 20+ year time horizon. And so, we would possibly challenge the thinking a little bit around the need for any kind of significant or any allocation to traditional fixed interest. I think another thing as well that 2020 has certainly taught a lot of people is that it's actually just better to have a higher cash reserve. So sort of reinforce the need to have a solid emergency account and maybe topping that up instead. And then it just means that, particularly if you're possibly going to be reliant on those investments in the future, you're never a forced seller in a downturn. So that's really what you're trying to, avoid.
And yeah, as exactly you pointed right. People got to remember we've still got a long life ahead of us when we reach retirement age. I think it's something like 25% of Kiwis will still live into their 90s. So if you think you get to 65 and you shouldn't be going and putting it all in cash on your 65th birthday, because the odds are you've got 20, 30 years in front of you. And so you've got plenty of time to ride the ups and downs. Otherwise, one of the bigger risks for a lot of people is they will put it in a cash or term deposit. And actually, if they're just eating into some of that every single year or drawing on it every now and then, running out of money is just as big a risk.
Yeah, for sure. So I suppose, other question for you, it has been a challenging year with markets. And one thing that we do naturally see is that people, whether they're either starting out investing for the first time, or they're shifting some money from typically, term deposits or cash and, starting to invest, they get a bit caught up in this notion of picking the right day. So, is this the week to invest, or is the market going to be turbulent in the lead up to the US election? How should I be thinking about that? What are your thoughts?
I have seen a million pieces of research on tied to US elections. I haven't spent the time or day to care about whether or not any of those articles that we read are actually factual or whether they're being cut in a certain way. One thing we did do, and it's again referring people to the blog, we actually looked specifically at the New Zealand market, and Kat, you'll hopefully remember how long we did this over. I think 15
I think it was about, I was going to say 17 years. So
yeah. We actually took the entire New Zealand market data for the NZ20 in particular. And what we did was a couple of assumptions. We said to somebody that was going to try and time the market as to they would hold on to their money in cash and then invest it when they thought it was at the bottom. And we compared that to somebody who just put in a regular amount every single week. And as you can imagine where we're going with all of this, the investor who just contributed regularly actually outperformed the investor who tried to time the market. So there's that piece. So if you have some cash flow ongoing or you have been some lump sum, it is still coming back to the fact that time in the market statistically is your best friend. So you just need to be in the market for longer. And that's the benefit of regularly contributing, is that you're not out of the market because it's very hard to time. The probably more personal element to it though is those that have a lump sum. You've inherited a lump sum or you've had a term deposit that's rolled off. We can talk about statistics and we can say that yes, statistically you are better to put it all in the market. It's 60-70% odds in terms of better putting in the market today rather than waiting. But it does ignore the human element there. And for some people, they'll have far greater comfort from just drip feeding that into the market. So if you have a lump sum at the moment, or you inherit a lump sum, or you have a term deposit that comes off, if you do have any apprehension, but you're comfortable in investing, do consider just a drip feeding in over several weeks, several months, whatever you may be comfortable with, because yes, that may mean that you get slightly worse returns, but it will be immaterial in terms of the benefit that you get from just the comfort of having taken that approach. And so you do have to keep that in mind, is that no matter what the data shows and what statistics people chuck at you, you have to operate within the realm of your comfort, because that's what investing is about. And that's actually what's going to make you a successful investor as well, is doing things that are aligned to your comfort levels and your interests. And that's probably the bigger message from everything tonight, is that you can do that, and it's just taking the time to work out what works for you.
Yeah, I think that's super important. I wanted to bring up fees because I know that is also equally important for all investors, but particularly when you're starting out, because it's easy to, I suppose, filter through options based on fees. So, Dean, what are your kind of thoughts around if I'm starting out or if I'm assessing, say, an index fund versus what I'm currently doing, whether it's active management or another fund? How should I be thinking about fees? How do they kind of work? Obviously, we can use Kernel as an example, but fund managers are all typically somewhat similar.
Yeah, so fees undoubtedly are important, and it is something you definitely want to consider. The obvious place to start, if you're looking at funds, is the management fee. So comparing the management fee of the fund, and you'll see that for Kernel, it's 0.39%, but actually, if you've got about 25,000, it becomes 0.29. So you can look at the management fee of the funds and you can compare them. That is a very simple exercise, and it's a good place to start, but you do want to take that to another level, because there are actually a lot of hidden fees and other costs that come into play with investing. When you're looking at index funds, one of the topics in the article I was referring to is the thing called tracking. And what you would typically expect from an index fund is the gross index return less the management fee of the fund. So obviously, you want a lower fee because you'll get closer to the performance. But there are some things that, as a fund manager, they can control, like us, that can improve on that more so than the fee. And so, without digging too much into it, because we've got some blogs on it and conscious of time, the best example from our fund so far over the first year was our commercial property. The return of the fund was actually 0.28% above the performance of the index after the management fee. So that's called positive tracking, and that's basically where we've done better than our fee and we've given the investor closer to the index return or more than it. So you want to look at that and see actually how well your index fund manager is delivering on the actual index performance itself after fees. But generally speaking, from all investments, management fees obviously is a good place to start. Index funds, you want to look at tracking. The other one is just all the other hidden costs that come to play. Are you paying transactional fees every time you trade? Now, if you're regularly contributing to your investment, you don't really want to be, paying fees every single time that you're putting into your investment portfolio once a week, once a month, whatever it may be. Are you paying hidden costs around somebody to hold your hold your assets on your behalf? What's the tax structure? You may be paying too much tax through some different investments. So there are a number of things that come in to the fees discussion that are beyond just the obvious ones, and you do want to take a little bit of time to do some comparisons. We do know, though, it is really hard to actually do. The management fee one is really obvious. Trading fees can be really obvious, but there are other costs that, like tracking, that may not be as clear cut. And so we are trying to help with that. So we've got a calculator and some blogs that we're working on at the moment to help investors assess different tax implications based on how much they're investing, what sort of investment they're going into, what's their personal tax rate, because that can determine or have a big impact on the sort of decision that you want to make around investment type.
Yeah, absolutely. And I suppose, it obviously is a Kernel webinar, so we're just going to say we're super upfront and transparent about our fees. We won't bang on about it too much, but we do have all of that information available on our website. It's not something that we're trying to hide. And, I think it's worthwhile also touching on the fact that this is our starting point. Sometimes people do ask us, well, how come as an index fund manager you can't compete with, say, some of the giant index funds on a fee level in the US? And, it is all relative. A lot of things can come from scale. We certainly would not plan to increase our fees over time. So as we go, this is probably our starting point. And Dean, I suppose in the spirit of time, before we let everyone go and enjoy the rest of their Thursday, given this is, a start to index investing, what would be kind of your top 2 or 3 tips for either starting indexing for the first time or, thinking about where to from here?
So I would say read our blog. That's the best place to start.
Yeah.
So there are a couple of really good blogs in there that you want to check out. One is what is an index fund and how does it operate? So we dive into a little bit further around some of the rebalancing and some of the other things that causes an index to change and what we do as a manager. The next one is, I think we called it How to Perfectly Time the Stock Market. And that is just showing you the data of what we looked at from a New Zealand market in terms of trying to pick the market timing versus just regularly contributing. The other big blog that I really suggest, particularly if you're interested in index investing, which we hope you are, obviously, if you're watching this, is the 7 tips for picking a good index fund. And so that's just going to summarize those kind of key things that you want to look at alongside management fees to pick the right index fund. Overall, though, as an investor, whether you're getting started or whether you're well on your journey, it's basically highlighting that there is a lot of choice out there. There are options out there that will suit your specific objective, and that can be a dividend strategy, or it could be growth, whatever it may be, and it can suit your time horizon. So take a bit of time, look at your options. Don't overcomplicate it. Touching on the diversification point, you don't need to own a dozen index funds, but you can pick 2, 3, 4, 5 that together will be something specific to you and help you to achieve your objective. The one thing we probably haven't touched on as well that is probably the most important is don't keep changing your investment strategy. That's probably a big piece that we haven't touched on. And it's with real-time information and being able to check everything on your phone and seeing news headlines pop up all the time. It's really tempting to go in there and change your investment strategies or sell something because it's been performing badly or vice versa, it's performed well. Once you've come up with your strategy that suits you and your objectives, there's no real reason to change it. So just check it once a year and only adjust it if you think your personal circumstances have changed, and don't react to the news headlines. So that's probably the bigger piece.
Yeah, I couldn't agree more on that. It's sometimes we're our own worst enemies. So it's definitely a good idea to tune out from those news headlines every now and again. But yes, anything else, Dean?
No, I just quickly look through. I do realise, Ben, I did properly touch on your comment. Yes, bond indices do exist, and you can buy bond index funds. We've obviously talked about bonds generally tonight. I'm happy to pick that up. Actually, if you remember that chart where I showed the performance of how most stocks underperform, funny enough, the bond world works completely differently. And so indexing in the bond world is actually a whole other topic. So we may have to touch on that at some point. But yes, bond indices do exist. Dividends. Now, we have had a couple of questions on this. How do investors benefit of any dividends? So one of the things that we do, if you think about the index fund, if it's made up like our global 100, there's 100 companies in that, and they're all paying dividends at different times. At the fund level, what we do is we make sure that they are reinvested. So they're continually invested back in the market for you so that you're not missing out on any performance. But at a fund level, all of our funds are consistent. So for Kernel, we standardized our overall offering. Every single fund has the option of receiving a dividend quarterly, or you can have that automatically reinvested so it continues to grow for you. There's obviously no fees with any of that, but you have the option of being able to pick and decide whether you want to have dividends paid out or reinvested, depending on what your specific objective is. And auto invest, yeah, we do have auto invest. If you can auto invest with Kernel weekly, fortnightly, monthly, as often as you like, any of the funds or any combination of the funds that you like. Again, we have no transaction fees. So every time you invest in one of the funds, it's all inclusive. That's everything captured. So keep it real simple. If there's any other final questions, just fire them through. But otherwise, hopefully you've had a good overview of index investing, from a brief history of indices themselves, obviously comparison of active management, and there are definitely a lot of questions that came through that we haven't touched on that I think we'll pick up on some further events or webinars. I know Kat and I are quite keen to get back out and around the country and do some of these things in person. So now that we are free, we'll have to do that.
Yeah, for sure. Yeah, so thanks everyone for joining us, and of course submitting your questions. We are always on chat online on our website, so kernelwealth.co.nz. You can also shoot through an email to support@kernelwealth.co.nz at any point. Our team handle all of that, so you're going to get a real human on chat. We do get asked that a lot, and we're more than happy to have these discussions. So if there's ever anything you need help with, please shout out. Otherwise, enjoy your Thursday. Yes?
One more thing, and I keep getting in front of you, to wrap up. Just do send through suggestions as well. So yeah, as well as just through questions, if you've got any suggestions or requests for topics you want us to talk about, blogs, any fund ideas that you want to see brought to market, yeah, that really does influence what we do going forward. So we do get that regularly, but encourage you to send through all of your suggestions and feedback.
Yep.
Thanks,
Awesome.
Kat.
All right. Thanks, Dean. Enjoy your weekend, everyone. It's almost Friday, so we've made it. Have a great night.
Thanks, Miss.